Very good evening to all of you. So we are going to continue with from where we left. So last class we had continued with PGBP, profit gains and business of profession. In this session also we are going to continue with the profit and gains of business of profession. So what did we cover in the last class? We were actually covering something like the what are all called as business, what is called as profession, and then we also discussed about the terms, right? Profit, gains, business, profession. And then we understood section 28. What are all called as income? What we said section 28 is the charging section. In section 28, what will be categorized? What will be categorized as business or profession, PGBP. So this is what we had covered under section 28. Then we moved on with the structure. What is a structure? We said section 30 to 37 is an allowable section, which says what are all the expenditure that is allowed as a deduction. Then we said 40 and 40A is about inadmissible deductions. Then we spoke about 41, which is deemed income, 43B, which is on payment basis. So these are all the sections we said is the structure on how you compute PGBP. We started with certain sections, that is 30, 31, and 32, right? So we started with these sections. In 32, that is depreciation section, we had generally covered what is depreciation, what is the requirement of a depreciation. That is, there must be a specified asset. The asset must be owned or owned by the assessee, used for the purpose of business. So these three things we discussed, and we also discussed about the rates. Today we'll continue from here. But since some of you have certain doubts relating to the earlier class, so I'll just try to convey some of the answers. So Manisha Ben, is illegal income is also considered as income. We saw in the brief introduction of business, illegal income, illegality is irrelevant. So whether it is illegal or legal income, it is still an income. Ayush, I will go some of your questions, which is relevant. So basically, you wanted to know, given under the clause 23 of 28, that income arising only from specific activities in context of association, how come we know the specific activity? See, basically, you wanted it from a practicing CA perspective. I'll give a perspective from an intermediate level, because you should not go overboard with what you need to know, because as you're restricted to your knowledge to what you need to know at this point in time, it will help you. So when you say association, some income is taxable and some is not taxable. It is a topic where I told you it will be in detail covered in trust. There are certain incomes for an association which will be taxable, certain not taxable. It depends on various conditions, such as application of income. For you're using the receipts received from the members. Let's say, as a chartered accountant, we are paying membership fee. For what is that membership fee used? So depending upon the usage, depending upon the application of money, there are some exemptions to that income. So depending upon that, it will be taxable, some will not be taxable. So as far as we need to understand from intermediate level, section 28 includes income from associations that are taxable under PGBP. So let's put it this way. If there are any taxable income from association, that income will be clubbed under PGBP from their trade activities, from their commercial, from their basic activities, whatever income they are drawing, that will be taxable under PGBP. What is transfer under the duty entitlement passbook scheme? See, duty entitlement passbook scheme is also an indirect tax concept, where again it is related to in certain kind of manufacturing process or something, or again related to import and exports, you are eligible to take credit of certain duties paid. So it is something like your drawback only. So for which you can take credit, like your input credit, right? So like your input credit, you are allowed to take credit of it, for which you'll be able to get refund or adjust it with your duties payable. So duty entitlement passbook is an adjustment, something like your input tax credit or something, which is, if there is any amount that is received from it, it becomes an income. So because, as we said, something like duty drawback, this duty entitlement passbook scheme is also, whatever you're receiving becomes an income. Why is partnership income? I guess I've clearly explained it in the last class itself. See, partnership income is taxable under PGBP. But if you ask me, can I pay how much ever salary I want? how much ever interest I want. I even told an example with respect to interest, only 12% on capital is allowed. So in case if partnership firm is paying 14% capital, what is considered as an income in the hands of partner is only 12%. The rest will be disallowed in the hands of the partnership firm. So whatever to the extent allowed under the law. So 40B tells you how much remuneration can be provided, how much interest can be provided. Of course, you can hold on for a while, probably in the next class or even the next class after that. We'll discuss about what the section 40 is, preferably in the next class. We'll discuss about what the section 40 clause B is about. What is multilateral fund? Again, I've told in the last class, Montreal Protocol is an international arrangement. So there is a fund distributed about it. So I don't think we need to go into the detail of what exactly it is. So this Montreal Protocol is an international arrangement where you are being paid some compensation. That compensation is not taxable under PGBP. Unless it is exempt under section 10, we'll have to see under the specificate. So section 10, if it's not exempting this Montreal fund, then it will be taxable under income from other sources. So I guess I've answered all the questions. So we'll move on to the current session. So we'll start with the first thing that where we left off. We left off with depreciation, right? So we'll start with depreciation itself. We'll start with the concept of actual cost. Now, when we understood this depreciation, depreciation is basically, let's say, cost minus cost into the rate, right? Cost into applying the rate will give you the depreciation. In case of written down value method, we'll keep it as WDV, right? So we need to understand these two terms. What is cost? What is WDV? We need to understand these two terms to properly come out with computing this depreciation, calculating this depreciation. So to start with this session, we're going to understand these two terms. What is actually the cost of the asset and what exactly is WDV? To understand these two terms, I'm going to give you an introduction about section 43. Section 43. So what is section 43? It is something like section 2. What is section 2? So what is section 2? We said every act will have a particular section and most probably it will be section 2. We said to cover this particular concept, it will always be about depreciation. So to cover this, it will always be the section 2 will be the section which discusses about these things. So that's what we said. So what exactly is section 2? Section 2 is what? Section 2, as some of you answered. So section 2 is same concept as what? Section 43 for PGBP. So whatever you think section 2 is, keep answering. So whatever you think section 2 is for Income Tax Act, same thing, it is section 43 is for the head PGBP. So what is section 2? Section 2 is nothing but the definition section. So we said every act will have a definition section. So this section 2 is for definition for Income Tax Act. Similarly, in PGBP, if there are for any additional definitions which are relevant for PGBP. So for the purpose of PGBP, this section 43 discusses about this PGBP definition for the concept of PGBP. So some of the key terms for this head alone will be discussed here. So some of the concept discussed here is cost, and then you have WDV also. So 43.1 provides the definition for cost. So what exactly is cost about? So I'll just read the definition. It says actual cost of the assets to the assessee. Actual cost of the assessee. So it says actual cost, which means whatever you have spent to procure that, to acquire that asset. So that's what reduced by the portion of cost thereof if it has been met directly or indirectly by any other person or authority. So you need to reduce to the extent that it has been indirectly by any other person. So which means whatever you have spent, whatever the assessee has spent, the relevant person has spent, only that cost must be taken. Anything which has been met by someone else, compensated by someone else, should not be considered. So it could be like, let's take a small example from individual's perspective. when you buy an electric vehicle, there is a subsidy, right? There is a subsidy provided to you. So let's say the electric vehicle cost is, the EV cost is 1.6 lakhs. Okay. Now subsidy is, let's say, 20,000. Now 43(1) says your cost is only 1,40,000 because you pay 160, you pay, and this is refunded by the government to you. So your actual cost is only 1,40,000 because this 20,000 is met by some other person or authority. So whatever you are actually spending on that asset is only your actual cost. When you discuss about this concept of actual cost, we'll have to go back, or we'll have to go forward probably to understand a portion of 40A, which is about inadmissible deductions in certain circumstances. So in 40A, there is clause 3, which says, whenever an expenditure, any expenditure or any payment, any expenditure is made in cash, an expenditure more than 10,000, in excess of 10,000, is met in cash. It is not being paid by the prescribed modes. So what are prescribed modes? It has account payee check, account payee draft. Remember the term account payee. It is account payee check, account payee bank draft, and then you have electronic clearing system. Electronic clearing system is ECS. So which automatically gets taken from your account. And then you have through a bank account, through, let's say, net banking or any other prescribed electronic mode. What are the prescribed electronic modes? You have credit card, you have debit card, you have net banking, you have IMPS, that is immediate payment service. Then you have UPI, that is unified payment interface. Then you have RTGS, which is real-time gross settlement. You have NEFT, National Electronic Fund Transfer, and then you have BIM. I guess it's Bharat interface or something. So BIM is also a kind of UPI payment. So all these mechanisms are the prescribed electronic mode. So if the payment is made by one of these methods listed out here, then it is an eligible cost. If it is not being done, it is being paid in cash or not through some of these methods prescribed, then that cost is not eligible. So to the extent that it is being paid by cash, you don't consider it as a cost of asset. So you're losing the benefit of claiming depreciation on that particular portion. So that's what it is about. So we'll have to understand section 48 clause 3 to understand this. So what does it say? If you are paying more than 10,000 in a day to a person, then that portion, if it is relating to an asset, that is not an eligible cost. So actual cost will be cost minus whatever is disallowed. Let's call it ineligible under section 48(3). So that will be removed off. So it is there. So if you have purchased the whole asset through this payment of cash, then the whole asset is not allowed. So to that extent, it cannot be claimed as an expenditure. So that is 40(a)(3). So this is how you calculate actual cost. Now this actual cost is generally the cost, right? So there is no confusion about it. 43 clause 1 provides a definition of what actual cost is. But there are various different scenarios on how you need to arrive at the cost. So some of them is discussed here. And again, so we'll discuss about whatever is relevant here for your examination. So the explanation one says, asset used in a business was earlier used for scientific research. So there is this section 35 that we'll discuss a little later, a few slides later. So that 35 says, if you have purchased an asset which is going to be used for the purpose of scientific research, that expenditure would have been claimed as an 100% deduction. Okay, 100% deduction. Now let's say subsequently, if you're going to use it for the business, then you should deduct whatever was earlier allowed. So typically, let's say we are talking about 100% deduction, right? So if your cost was 120, 120. How much would have claimed as deduction? You would have claimed 120. So technically, what will be the cost? The cost for assets for which scientific research deduction has been claimed in the section will always be nil. Will always be nil. Why? Because it has already been claimed as deduction, 100% deduction. It is like 100% depreciation in the same year in which you have purchased that capital asset. So for such assets, if you are subsequently using it for non-scientific purposes in some other business, then you will have to, the actual cost of that becomes nil. So how does this matter? In case if you're selling, the entire sale proceeds becomes your gain, right? So that's what is important. So the cost in scientific research, the cost will be nil. So that's what it is about. Then the EXPs written here stands for explanation. So these are explanation numbers provided under section 43 clause 1. So explanation 2 says the asset that you are currently owning is being acquired by way of gift or inheritance. Gift or inheritance. So what does it say? It says the actual cost for you, that is, let's say I am the current owner who have got it by inheritance. My father's through will, I have got that particular asset. Now this asset, whichever I'm going to use, the cost of this asset to me will be the actual cost to the previous owner. So this is me, this is my dad. So through inheritance, my dad has given to me. So the cost to dad minus the depreciation as if this is the only asset in that block. So you continue giving, let's say my dad got it like 10 years back, I'll have to provide depreciation for 10 years. If you had got it 5 years back, I'll have to provide a depreciation for 5 years. So for that period, okay, for that period, I need to provide depreciation. So the difference, the actual cost of dad minus the depreciations provided for that particular asset that is the only asset, the difference, whatever I'm arriving, will be the actual cost to me, So here we are talking about actual cost in case of gift or inheritance. Okay. Next is explanation 1A. Explanation 1A. So what does it say? It says inventory converted into a capital asset. So we spoke about section 28 where we said when a stock is converted into a capital asset, what did we say in section 28? We said fair market value on the date of conversion. We already discussed this particular element while we were discussing about section 28. So what did it say? It said fair market value on the date of conversion to capital asset shall be treated as the actual cost under section 43 clause 1. So that's what it is about. Now, how do you determine FMV? I've been telling you this. For some cases, we are using this word prescribed manner. That prescribed manner, you will have to wait to know till final. So typically, whatever is how do you arrive at the fair market value is discussed in a particular rule, which is only discussed in your final chapter. So as of now, for intermediate level, you will be provided with the fair market value itself. So there may not be a situation where you need to calculate the fair market value. So what should you understand for time being? That is in your level. What should you understand? You should understand that fair market value of that particular inventory on the date of conversion into capital asset shall be the actual cost. Correct? So that's explanation 1A. We'll move on to the next explanation. I am skipping your study material will have explanation 344A. I'm skipping because it is definitely relevant only for the final thing. So whatever is there, if some of you wanted to know, you can of course read it. But this thing, you can restrict it to final. It may not be important for your intermediate. It is not relevant for your intermediate. It is just part of the study material because just to cover the entire section of section 43. Otherwise, this 3, 4, and 4A, you can keep it for final. So we'll jump from explanation 2 to explanation 5. So this explanation 5 discusses about building previously owned. What is the term? Building previously owned. So what do you mean by that? It is owned by someone else. It is owned by someone. It is owned by assessee only. Now it was owned for personal business purposes. Now owned for personal purposes. Now it is owned for business purpose. So the transformation is personal to business. So all these years he was holding that building for personal purposes. now is moving into transferring into the business purposes. So how do you treat this? So that is discussed in explanation 5 to section 43, clause 1. So what does it say? It says actual cost to assessee and depreciation till date. Depreciation till date as if that asset has been used for the business only. So this is for building. So if you actually see that model that we have discussed in explanation 5, the model we are discussing in explanation 5 and the model we are discussing in explanation 2. Explanation 2 and explanation 5 is same. Explanation 2 and explanation 5, the model. Every model talks about actual cost to the assessee minus depreciation till date. Similarly, actual cost to the previous owner minus depreciation allowable till date. So that's what we are talking about, explanation 5. So moving on, explanation 8 and 9. So 8 is about capitalization of interest cost. Just one thing alone, this explanation 5 is only for building, So if it is something else, you need not apply this. So this concept that we are talking about is only explanation 5. So if it is not building, if it is some other asset, you don't provide depreciation and all. You provide whatever is the actual cost, the original cost, you start depreciating from that only. So no fair market value, nothing. Only for building, we are talking about a situation where you provide depreciation till date and then take that as the cost to your business. So that's what it is about. If it is other than building, there is no such concept. Explanation 5 does not apply for other areas other than your building. So that's what it is about. So coming back to the explanation 8, explanation 8 is about capitalization of interest cost. What interest are we talking about? You take a loan, you repay. Okay. So when repay, you pay both principal and interest. Okay. Now, generally interest is a P&L item, principal is a balance sheet item. But there is a scenario where you need to take this interest also to balance sheet. When? Interest in connection with the acquisition of asset relatable to any period after such asset is first put to use. So first put to use shall not be included and shall be deemed never to be included in the actual cost of such asset. There is a beautiful phrase in this Income Tax Act. So it says, shall be deemed never to have been included in the actual cost. So that's a phrase, right? Shall be deemed never to have been included in the actual cost. So typically, when is this phrase used? This phrase is used to say that, let's say there is a provision introduced in 2019. Now you need to clarify. Sorry, I jumped somewhere. Okay, now you need to clarify. So when you're clarifying, income tax says, I never had the intention, we, the income tax department, never had the intention to adjust this interest after first use. Interest after the asset has been first put to use with the cost of the asset. So the only intention of income tax department was to capitalize interest cost till it is first put to use. So what do you capitalize? You capitalize till it is first put to use. So if a particular asset purchased in 2000, let's say 1st June 2018. So it is under construction or installation or whatever period. It is completed. It is ready for use on 1st June 2021. Okay. This period is capitalization. Anything after, so after 1/6/2021 is what? Is to P&L. It is the revenue item. So that's what this explanation 8 says. Explanation 8 says your interest cost on the loan that has been obtained to acquire an asset can be capitalized only till the date the asset is first put to use. First, first put to use. The income tax has very critical words, right? So because each word matters in Income Tax Act. So what does it say? First put to use. And it says shall be deemed to have never been. So irrespective of the date in which this provision was introduced, forever this understanding is interest only till the date of first put to use is capitalized. After that, it is not capitalized. It can never be capitalized. So that is explanation 8. So when you're adding actual cost, you should include interest till it is first put to use. So that's what the provision says. Next, explanation 9. What about the customs excise on which you have claimed credit? Something like your GST only. So what happens in GST? You may claim credit, right? So now, if you have taken the credit, then that cost should not be part of your actual cost. Logically correct, right? So when I say my asset cost is 120, out of 120, 20 is tax, 20 is cost, 20 is tax. Now this is credited back. So I get back this 20. So what will be my actual cost? Only 100. Because this 20 I've got back, right? I've got back this 20. How can this be my cost? So this 20 is given back. So my actual cost is only 100. So whatever is relating to excise or customs, in which credit is claimed and obtained for that particular asset, which can be adjusted. So that can be adjusted to the cost that does not form part of your actual cost. Okay. Next. Explanation 10. Explanation 10 is where you have given subsidy, grant, or reimbursement. So subsidy or grant or reimbursement for the asset provided by central government, state government, or any authority established under any law or by any person shall not be included in the actual cost of the asset. We already saw that in definition itself, right? So the actual cost includes only the cost borne by you, borne by the assessee. It shall not borne by a cost which is directly or indirectly borne by someone else, by some other authority. So that's the same concept. So typically you should not include this cost. So shall not be included in the actual cost of the assessee. What if there is any subsidy, grant, or reimbursement, and where the benefit cannot be directly related to the asset acquired. Now let's say I'll just explain this. I got a land. I got a machinery. Okay, land is, let's say, 10 crores. Machinery is 1 crore. Okay, now income tax, that is the government says, let's say this is some business. For this business, government says we'll give you 10% subsidy. So government will give me 10% of this cost, invested cost. So how much will they give? They'll give me 1.1 crore, right? So 1.1 crore will be subsidy. This 1.1 crore is total, which relates to both, right? Which relates to both. Now I need to split this 1.1 crore in the proportion. So 1.1 crore into 10 by 11. Similarly, 1.1 crore into 1 by 11. What is 11? The total investment cost. What is 10? It is only relating to land. What is 1? It is only relating to machinery. Okay. So that's how you actually take the proportionate. So that's what the provision says. But the benefit cannot be directly related to the asset acquired. Proportionate subsidy or grant reimbursement shall not be included in the actual cost of the asset to the assessee. So only the proportionate grant alone will be removed from the actual cost. Rest of the thing will continue to be there. So that's what it is about: subsidy, grant, or reimbursement for that particular asset. Now, explanation 11. It is basically when it is an already an used asset. Where is it used? It is used outside India. So asset acquired outside India is bought by a non-resident into India. So again, here it is actual cost to assessee, depreciation as if it is used in India. So we remember the provisions explanation 2, where we said previous owner, same model. Explanation 5, where we said building, same model, actual cost to the assessee minus depreciation allowed till date. Here it is explanation 11. So all these things have the same model. What does it say? Actual cost is equal to actual cost to the assessee or the previous owner in case of explanation 2, and depreciation allowed as if it is being used by the assessee. used in India. So same concept. So that is what you need to do. So understand the provisions in an interlinked manner. When I'm talking about 2, my mind should also think about 5 and 11 because the model is same. When I talk about previous owner, my mind should also talk about explanation 5 and 11 because there are similar models about it. Similarly, explanation 10 is about subsidy grant. Explanation 9 is about customs duty, excise duty, claiming back. Everywhere you are adjusting that with the actual cost. Please understand in a linking manner, interlinked manner. Provisions are interlinked. When you interlink the provisions and understand, you remember it better. You need not confuse yourself with the provisions. So that is explanation 11. So this is all about actual cost. Whatever we saw now, 1, 1A, 2, 5, 8, 9, 10, 11, all these explanation is what we are talking about with respect to actual cost. And as I told you, I did not discuss 3, 4, and 4A because it is not relevant to your intermediate. Okay. Now, we'll move on to the next definition, that is with respect to WDV. Before that, I'll answer some of the questions. Whether additional depreciation applied in first year or every year, it is only applied in the first year, Sundhya, right? So it is only applied in the first year. So the additional depreciation is only for first year because it is new in that year. It is only for new. It is only for new assets. When will an asset be new? Only in the first year. The second year onwards, it's no more a new asset. So only it is applied in the first year. So that's the thing. Only in case where it is less than 6 months. Less than 6 months in year 1, in the year 1, then we know that the provision is only 50%, correct? 50%. So for additional depreciation also, it is 50%. So you will gain 10% in first year, 10% in second year. So only in case where it is used less than 180 days. Sakshi, what is meant by asset in block? Okay. We'll probably take plant and machinery. Plant and machinery has various rates, okay? So it has rates for car, it has rates for car, non-hire, car hire, even your computers are all part of plant and machinery only. Now, you also have general plant and machinery. So this is block 1. This is block. This is another block. This is another block. So if you're buying 4 computers, when you're calculating WDV, you'll calculate it for 4 as a block. That is 4 put together. It will be 1 block. So block of assets means group of assets under the same category. Group of assets under the same depreciation rate. Group of assets under the same depreciation rate for that particular category of assets. So that's what you mean by block of assets. Clear? Okay. So we'll move on. So what is the next term? We said 43 clause 1 defines you about actual cost. Now what are we going to understand? We are going to understand the next term. What is the next term? We are going to understand about WDV. We are going to understand about WDV. That is clause 6. Clause 6 discusses about WDV. So when you're actually calculating WDV, that is what is WDV? The written down value. So how do you calculate the written down value? Now we are going to understand what happens for a newly acquired asset. What happens when an asset is already acquired? For newly acquired assets, WDV is nothing but the cost determined under section 43 clause 1. So whatever is the actual cost under 43 clause 1 will be your WDV in the first year. So you apply depreciation rate on WDV only, because for Income Tax Act, almost for all the assets, you only apply written down value method. Only for power generation unit, we said there is the option of, there is a concept of straight line method. And if they want, they can choose written down value method in the first year itself. So we said that. For everyone else, it is only written down value method. So in the first year of acquisition, written down value of that particular asset is nothing but the actual cost under section 143(1). What about the assets acquired earlier? So the WDV will be nothing but actual cost minus depreciation till date. Similar to what? Similar to what? Explanation 2, explanation 5, explanation 10. So all of this we said actual cost minus depreciation till date of the previous owner of the used in India, building being transferred. So all these things we discussed about the same concept, actual cost minus depreciation till date. So here also for 43 clause 6, where an asset is acquired before the previous year, that is for an old asset, what happens? Your WDV is nothing but actual cost minus depreciation till date. So that's what it is about. So for block of assets, so we said acquired during the year, acquired during the earlier year. That is all about one single asset. Now, what if there is combination of assets? There are 4 computers, 2 acquired 2 years before, 1 acquired earlier year, 1 acquired current year. How do you do it? So all those 4 becomes a block, right? So what is the structure? What is the structure of this particular thing? So the structure is basically, first thing that you take is WDV as on 1st April of the previous year. So WDV as on the 1st April of previous year. So what it is about, on 1st April, if you're talking about previous year 21-22, it is about 1st April 21. 1st April 21. So that will be the WDV as on the 1st April of the previous year. With this, if you have acquired any asset during this previous year, so what previous year we are talking about? We are talking about previous year 2021-22. So if you have acquired any new assets of this block, we need to add that. So you get this total. From here, you'll have to less money receivable. What is money receivable? Let's say you have sold the share, sold the asset, or you have scrapped the asset. You have scrapped the asset. You're getting any scrap value. So money receivable regarding that particular asset. Let's say one computer went bad. I'm giving that asset as scrap, or I'm selling it off. So whatever money I've received against that asset, the sale consideration, money is receivable is nothing but sale consideration. Whatever as a sales cost or scrap cost. So sale consideration or scrap value. So this is called as money is receivable. So that is reduced from that. And the next concept is slump sale. So what do you mean by slump sale? Actually, again, slump sale is also more for final syllabus only. It is relevant for your final only. But I'll just briefly explain you what it is all about. Slump sale is basically wherever you have an asset. Okay, you have an asset. You have, let's say, machinery, building. You have a car. You have a laptop. So you have so many assets. Machinery, building, car, laptop, whatever it is. Now, for these assets, whatever we are talking about, all this put together. So this is my business. For this, I'll have some liabilities also, right? Loans and other things. Now, I am selling my business. Okay. I sell my business. So what am I doing? I'm selling my business. So when I'm actually selling my business, I value my business. I don't value each asset. I value my business. So this concept is called slump sale. I don't value each asset. I value the business as a whole, which will have so many assets, so many liabilities. So all this put together is if I'm actually selling it. Now, what I need to do is I'll have to remove that. Since that is also sold, I need to remove that also. I don't think you'll be tested on this particular line in your intermediate. But anyways, I think I've explained you the concept. So slump sale is selling a business as a whole. Since that asset is also sold, I'm writing off that asset by actual cost minus depreciation. So whatever is the WDV of that particular asset, I am writing it off. Less goodwill. Since there is a new amendment of goodwill saying goodwill is no more an intangible asset. So this goodwill, whatever was the goodwill value till previous year 1920, that is actual cost minus depreciation, that is also removed. So I'm removing 3 things. What 3 things? money is receivable as an asset, whatever is being sold, and then the slump sale, which is also sold, and then you have goodwill as far as this asset goes, whatever is the goodwill. So this goodwill also sold up to previous year 1920. So all these three is what you're actually calling it as. Whatever you're calling, you have to remove it from the WDV. So your money is receivable, your slump sale, your goodwill. So all these three are removed. All these three are removed from your WDV to get at the actual WDV at the year end of. So it is C minus D minus E minus F. So on this WDV, you reduce, you apply the depreciation rate. So you apply the rate applicable to it. One thing that you'll have to keep in mind is your depreciation cannot go above WDV. Depreciation cannot go above WDV. So your maximum depreciation is WDV. So typically, when does this happen? Is whenever you have sold assets, since you have slump sale, goodwill, or money is receivable, sometimes what happens is your WDV might be much higher. So if you're applying the rate, it might go negative. So your WDV cannot go negative. So you restrict your WDV depreciation to the WDV. So the net difference becomes your WDV as on 31st March previous year, which will be used for 1st April. So that's what WDV computation is about. So again, let me repeat. So in short, what should you do? You take opening WDV, add cost of new asset, then less sale value or scrap value of sold asset, then less slump sale, that is cost minus depreciation of that particular asset, then less goodwill, again here also cost minus depreciation. So this will be your WDV. On this, you apply depreciation rate to get closing WDV. So this is how you need to work out WDV. So this is all about your WDV. Of course, when you're solving problems, we'll understand this a little better. Okay, now there are certain cases, certain deviations to this WDV. Similar to cost, we saw some deviations. So similarly, in WDV also, you have some exceptions, different way of accounting. So the first thing is, it is about a business which is exempt, Let's say I have a business which is exempt to tax, let's say under section 10A. Okay, so 100% of my profit is not taxable. So I would not have computed, because my entire business income is actually exempt. So I would not have calculated anything. So there is nothing exempt. But suddenly it is taxable, let's say from previous year 2021-22. So it is taxable from previous year 21-22. So now let's say this business is there from 2015. So now what happens when I'm actually taxing it in this year, when I'm actually making it taxable in this year, this becomes my first year in which it is taxable, correct? So what provision says is, when you have an exempt income, when it is being exempt, when the particular transaction is being exempt for all these years, suddenly become taxable, you don't calculate income tax act depreciation. Whatever you have provided depreciation in the books of account, so whatever is being provided in the books of account shall be deemed to be the WDV, for income tax purposes. So the book value, that is book value on 1st April 2021 will be the WDV under section 43.6. Okay. So why? Because this 43.6 is what talks about WDV, and it says if it is relating to an exempt business, what you need to do is you must actually treat the book value as the opening WDV for section 43. clause 6 as WDV. And in some cases, WDV should be treated as nil. In some cases, WDV should be treated as nil. In what cases? In two cases. The first case is the monies receivable, that is sale value that we are receiving, exceeds the WDV itself. In that case, in second case, if all the assets are transferred, I'll explain you both. I have 3 cars, okay? 3 cars in one block. I have 3 cars in one block. Now the opening WDV is, let's say, 1 lakh. Now I am selling 1 car in that. I am selling 1 car sale. It is sold for 2 lakhs. Okay. So what happens? My money is receivable. So this is what is called as money is receivable. So my money is receivable is greater than WDV. So my WDV will be considered nil. It will not be put negative number. It will be treated as nil. Why? Because my money is receivable is greater than the opening WDV. I have only sold 1 car, but it is greater than the value of 3 cars put together. Then it is nil. The second situation, what happens? I have 3 cars. Okay. Opening WDV is how much? 1 lakh. Less 3 cars is being sold. All the 3 cars is sold for how much? Let's say 50,000. So now this will not be WDV. This will not be considered as WDV because the entire block of assets ceases to exist. So my WDV will be nil. So in these two circumstances, my WDV will actually be nil. So can we understand a problem now? So it is basically admissible deductions. There is a concept of composite income. The next thing that we are going to understand about this concept of composite income. So what do you mean by the term composite income? So composite income is where it is one income. Part of that income is taxable. Part of that income is not taxable. Part of that income is taxable. Part of that income is not taxable. So in that cases, we'll compute the depreciation for a whole. We'll not compute only for a taxable portion. We'll compute the depreciation for a whole, and whatever is computed for the whole amount will be considered to be the actual depreciation. So whatever depreciation is computed for the whole will be deemed to be actually allowed to the assessee. Though only a part of it is actually taxable, the rest is not taxable, I will still treat the entire depreciation as allowed. So for this, one of the good example is manufacturing of tea. Manufacturing of tea is partly agriculture, partly business income. How much is agriculture? 60% of it is agriculture income. And 40% is taxable under PGBP. Remember, you would have studied in the earlier chapter, you have coffee, rubber, and tea business, where you have certain proportions. So in that, for tea business, 60% is agriculture income, 40% is taxable under PGBP. So now, depreciation will actually be calculated for the whole number only, but whatever is taxable is only 40%. How do you do that? So for example, let's take your income will be 20 minus 1 minus 4. So first you calculate the actual income. So your income will be how much? 20 minus 5 is 15, correct? 20 minus 5 is 15. Now, in this 15, agree PGBP. So agree is 60%, PGBP is 40%. So 40% will be 6, this will be 9, correct? So this 6 is taxable. This 6 is taxable. But even if you actually see, the depreciation for the 6 is only how much? 40,000. 40,000 is only a depreciation towards this taxable income. But for the purpose of WDV, you don't split between taxable and non-taxable. Your WDV will be after reducing the whole depreciation of 1 lakh. So you'll have to consider the whole depreciation, not the depreciation only on the amount in which it is taxable. So that's what you're referring to, composite income. So the depreciation should be for the whole amount for which you have earned, not only for the taxable amount. So that's not how you compute depreciation. So your WDV is after that, taking the whole depreciation. Your WDV is considered of taking the whole depreciation, not the depreciation towards the taxable portion alone. So that is for composite income. So that's clear, right? So the last one area that we'll understand in depreciation is what about the carry forward set off? You call that as unabsorbed depreciation. You call this depreciation as unabsorbed. So what do you mean by that? When you don't have sufficient, let's say my income is 10. Okay, this is my income, but my depreciation is 12. So my depreciation is higher than the profit itself. So I don't have sufficient profits to claim allowance of my depreciation. So in that case, whatever is the difference, in our case it is 2. So this 2 will be carried forward, and added to the depreciation of the following previous year. So if this is relating to 21-22, it will get added to 22-23. It will get added to 22-23. So in 22-23, this 2 will be added to the depreciation along with whatever was the depreciation for 22-23. So that depreciation can be continuously carried forward, and there is no definite period. So it is indefinite. There is no limit for carrying forward this unabsorbed depreciation. It doesn't matter whether the business is in continuance also. So it could be set off even if the business is no more in continuance. So your unabsorbed depreciation can be carried forward for n number of years, indefinite years. So there is no restriction. So since it has indefinite period, when you are adjusting the losses, you first adjust losses or something which has definite period. Only then you adjust this depreciation. So it will be last in the order to set off. So typically the first preference is given to current year depreciation. The second preference to brought forward losses. Third is given to unabsorbed depreciation. The similar concept applies to scientific research under section 35 also. We'll see that a few slides later. So whatever we have discussed for carry forward set off will also apply to scientific research under section 35. So if you don't have sufficient profit to adjust the scientific research, it can be carried forward for n number of years. So that's about your depreciation. So next one is an illustration problem. Before that, I'll take some of the questions. Karthik, whether we can claim depreciation for 2 other cars? In this case, no. You cannot claim depreciation because you cannot claim depreciation. Why? Because the entire block ceases to exist. Because you have sold all the, sorry, not in this case, right? Your question would have been for, your question would have been here. So here, since your WDV is nil, you cannot compute depreciation for the other 2 cars because the depreciation applied will become 0 only. You will be applying on this only, right? So you'll be applying depreciation on the WDV only, closing WDV. Since your closing WDV is nil, you cannot apply depreciation. So technically speaking, you will not be applying depreciation for the other 2 cars. So that's what is Karthik. So you cannot apply depreciation for the other 2 cars because the WDV itself is nil. The WDV itself is nil. So that's what we are talking about. This provision, correct? So now we'll move on to the next category. So we'll solve some illustration with this problem to understand this better. A newly qualified chartered accountant, Mr. Dawal, commenced practice and he has acquired the following assets in his office for financial year 21-22, that is previous year 21-22. Calculate the amount of depreciation. So they wanted to do. So now they say they have incurred cost including computer software. It is acquired on 27 September 2021, but it is put to use only on 1st October. And then you have UPS 2nd October and 8th October. Then you have computer printer, that is 1st October. It is used on the same day. Books. I forgot to tell you this. When I was actually explaining you the rate of depreciation, I forgot to include books in that. Books is also one of the line item which will be periodically tested in your examination. Books is basically eligible for depreciation at 40%. Books are 2 categories. One is, let's say, professional firms. Not everyone are eligible for book depreciation. Only two categories. One is professional firms like chartered accountant, lawyer, or someone. For them, book itself is an asset because you will be buying Income Tax Act, you will be buying Companies Act, right? So you'll be buying so many books relating to chartered accountancy practice. So those books becomes an asset to you. So whatever you are paying for those books could be annual publication or could be any other book also. That book is eligible for depreciation at 40%. And for person who are in library field, who are actually running a library, the business of library, for them also books is eligible to be deducted at 40%. So basically, books for professional firms and library is eligible for 40%, irrespective of whether it is what it is, annual publication or other than annual publication. So that's what it is about. So book is also purchased on the 1st April and put to use on the same day. Furniture acquired from a practicing CA. So it's a second-hand asset. It has been purchased for 3 lakhs. So office furniture has been purchased for 3 lakhs. It has been put to use on the same date. Then you have laptop, which is 26th September and 8th October. So which is 43,000. So these are the assets which you have actually incurred. So now, how do you actually compute this? So we'll have to calculate two things. We'll have to understand how much is for more than 180 days, how much is less than 180 days, and then do the rest of the thing as blockwise. So what is blockwise? So we said separate categories. So here, if you actually look at it, furniture is alone a separate category. Rest are all called as plant and machinery. Your computers, your books, everything falls under plant and machinery block only. There are around 14, 15 blocks in plant and machinery. So all this comes under plant and machinery. Just as the rate differs. For computer, for book and all, it is 40%. For general plant and machinery, it is 15%. Here, everything given, there is computer, UPS, printer, books, laptop, everything is covered only in 40%. So your exam, your question paper, this question gives you only 2 blocks. So now we'll solve this. This is what illustration number? Illustration 3. Illustration 3, right? So you'll have to calculate whatever is the, let's say, computation of depreciation. You have particulars, whatever is the depreciation that you need to work on. So the first is furniture and fittings. It is taxable at 10%. Then you have plant and machinery. This is taxable at 40%. So this will be your total. This will be your total depreciation. Okay. So now we need to calculate. So first we'll calculate for furniture. We'll put a reference here. Reference 1 is for furniture. So furniture is basically cost. Cost is basically how much for furniture? It is 3 lakhs. So the cost of asset is actually 3 lakhs. Used whether less than 180 days or more than 180 days. The furniture was actually acquired on 1st April. So it is for whole year. So more than 180 days. So rate is 10%. So depreciation will be 3 lakhs into 10%. So that will be what? 30,000. So that is the only block. So you take 30,000. Next thing, we'll write 2 here. 2 is for computers. That is plant and machinery. Two is for plant and machinery. You have several assets. So for several assets, what do? You actually calculate, right? So basically asset rate we'll put it as period so that to understand whether it is 50% or full percentage, and then the depreciation amount. So this will be okay. Amount is also should be calculated, right? So we'll have value. Okay, so it will be 1 into 2 into 3. So that will be a depreciation price. So what is the first asset? Computer software. Computer, including computer software. So the computer software, whatever you discussed, is put to use on what? 1st October 2021. So it is more than 180 days. So to just remember, to have 180 days, I'll just give you a clean example. 30, okay, 30. So to understand when will you reach that 180 days? 30, April is 30, May is 31, so you get 61. June is 30, you get 91. July is 31, so you get 122. August is 31, so you get 153. September is 30, so 183, correct? 183. So this 183 is what is crossing this 180. So typically, you need to, if you have used it on, you'll have to remove 3 days, right? So you can keep it as what? 27. 27 will give you 180 days. So this 27. So 27, 9, the year. So that's what it is about. Generally considered as your, will be generally considered as your asset. So which is more than 180 days. Now this is being used from 1st October. So if I'm actually using from October, what happens? 31 October, November 30, December 31, January 31, February 28, March 31. So 61, 92. So 61, 92, 123. 123 plus 28 is 151, 31, 184. So if you're using it from 1st October, you have actually used it for 184 days, correct? So since you have used it for 184 days, it is there. So now it is actually being used on 1st October. So which means you're using it more than 180 days. So it is full depreciation. So here it is 35,000. So the value is 35,000. Rate is how much? Rate is basically 40% the depreciation rate. Period is full year, correct? So full year. So I'll write it as 1. Period is 1. So it will be 35,000 into 40%. 35,000 into 40%. How much is it? 14,000. Next is next asset that we are talking about is computer UPS. So computer UPS. So for computer UPS, it is on 8th October. When you say 8th October, it is automatically, here you have only left with 23 days. So when you are reducing 8, it becomes less than 180 days. So 8th October is less than 180 days. So which means only 50% depreciation is allowed. So 8,500, 40% is the rate. It is only for half period, correct? So it is 20%. So 8,500 into 40% into 0.5. So that is 1,700. The next asset is computer printer. So 1st October is basically your more than 180 days. So 1st October you will not worry about. So it is 12,500. So 12,500 into 40% is 1. So 12,500 into 40% is 5,000. That is printer. And then you have books. Books, I told you, it is actually eligible for full depreciation. It is 13,000. Both annual and non-annual publications allowed. What is the period it was acquired? 1st April. So the whole year depreciation. 40%. So it is, full year. So it is for full year. So 13,000 into 40% is 5,200, correct? So that is there. And then you have what? Computer printer, books, and then you have laptop. Yeah, you have laptop. So laptop, how much is that laptop? It is 43,000. It is purchased used on 8th October. So it is less than 40%, so 0.5. So 43,000 into 40% into 0.5. So that is 8,600. So the actual depreciation is basically how much? 15,700, 20,700, 25,900, 26,500, 34,500. 34,500. So you come back here, write 34,500. So total depreciation is 64,500 for this particular. So that's what it is about. So as I told you, whenever yes, the restriction of 50% will have been this 180 days is what we are calculating for every asset. The only thing is for every year, the 180 days here is basically, as I told you, you can calculate from the backward. We can calculate from the backward to understand what 180 days is about. So if we used in March, it is 31. If you have used in February, so if you have used in March, it is 31, February 28. So you do this back working to understand when the 180 days starts, right? So that is how you determine what is 180th day. So you determine whether it was actually used for more than 180 days or more, and then decide about your depreciation. So that is about your illustration 3. So now we'll move on to the next thing, illustration 4. So illustration 4 is Gamma, a proprietor, started a business, manufactured tires and tube for motor vehicle on 1st January 2021. So he has started his business itself is 1st January 2021. The units was set up on 1st May 2021. So May 21 is what he has set up, and he commences manufacturing operations on 1st June 2021. So typically 1st June only is his operation date. The total cost of plant and machinery is 120 crore. The said plant and machinery includes second-hand plant and machinery, which was for 2 crores, 20 crores. New plant and machinery for scientific research relating to assets of 15 crores. So typically, if you actually look out this question, the 120 crore is the total cost, right? Cost is 120. Less, you can't claim depreciation on what has been used for scientific research because you would have claimed 100%. So less 35, so 15 crore. So the balance 105. The 105 only is your depreciation, which you can provide. And this 105, let's say he has been using it for this entire period. That is your general plant and machinery. It only talks about general plant and machinery. So it is eligible for 50%. Less normal depreciation is 15%. So normal depreciation 15% will be 105 into 15%. It will be 15.75. Okay, 15.75. Then additional depreciation. Now additional depreciation, we said if it is actually allowed, that is this plant and machinery, second-hand plant and machinery is what is being actually purchased. So when we say second-hand plant and machinery, which is if you wanted to claim this additional depreciation, you cannot claim it on this 20 and 15 because additional depreciation cannot be claimed on second-hand machinery. It has to be a new machinery. So now second-hand machinery can be only obtained on 120 minus 20 minus 15. So it will be 85. So you can apply additional depreciation only on 85. How much is additional depreciation? 20%. So now 85 into 20%, you get 17. So your total depreciation is 32.25, 32.75, and WDV will be 120 minus, 105 minus 32.75. So that will be a WDV, 72.25. So that's what is your thing, correct? So now we'll move on to so after depreciation, we'll move on to scientific research. I'll see if there are any depreciation thing. I'll answer some of the questions. In Akashil, the set off mean being added to the following previous years. So once you are not able to set off your current year unabsorbed depreciation and you're carrying forward to the next year, that depreciation becomes next year's depreciation. So it get added along with the next year's depreciation. Kiran, if you have the whole profits for depreciation, yes. So in our example, we were just talking about a situation. I'll just take this. Let's say my actual profit is 10. My depreciation is 12. So what happens is there is a loss of 2. Correct? So unabsorbed depreciation is 2. My profit is nil. So no tax. So you're right. So since you adjusted the whole depreciation, then you will not have any profits to pay. Swati, if WDV is nil, what will you do for the rest of the 2 cars? The value of 2 cars is 0. The value of 2 cars is 0 because WDV is for the block. So we are not going to revalue and all. Once you say WDV is nil, it is for the block. So if the block has 3 cars or 2 cars, how many ever cars you have, the value is nil. So the value of 2 cars becomes nil. So that's what we are actually talking about. So the value of the 2 cars is nil. So good, Madhuri, have computed the depreciation correctly for 64,500. Hitesh, Akash, Neil. So yeah, for calculation of deal from 1st October, it is 182 days. So typically, if you're using it from 3rd October, if you're using it from 3rd or more than that, it will become 180 days. If it is used exactly for 180 days, is it full or half? See, whatever we are saying is, if asset is used is more than 180 days, so then only full depreciation. So for 180 days, it will be exactly half of the depreciation. Mansha, if WDV is negative and block of asset exits, then no depreciation will be charged. Mansha, if WDV is negative, automatically, see, in both the cases, that is in both the cases that we discussed, money is receivable greater than WDV and all the assets ceases to exit. In both the cases, capital gain comes into the picture. Since we are not talking about capital gain, I skipped that. But in both the cases where WDV is nil, automatically capital gain needs to be calculated. Sandhya, in illustration 3, we have calculated depreciation. Only thing is, this additional depreciation is applicable only for manufacturing or having new plant and machinery. So these are all office equipments. So we need not calculate any additional depreciation. But we have calculated depreciation for books. So we have calculated depreciation for books. So books has been included, just that there is no additional depreciation because it is all office appliances and it is not into manufacturing. Yeah, for Raghavan, for calculating days, we need to consider date put to use, not the date purchased. What is relevant is the date put to use. Yeah, Mansha, there are around 14 blocks in plant and machinery alone. So some of them are cars, your books, you have general plant and machinery, so all of them. So there are so many things in there. Siddhappa, 85, how did we calculate? Where is 85? I don't see any number as 85. It's some other old problem that you're talking to. I don't see any number as 85. So please specify where you have seen this 85 for me to explain. And of course, I'll upload the PPT after the session. I've uploaded all the PPTs till the previous class, so you can go through them. Okay, so with this, we have completed the entire chapter of depreciation. So we'll move on with scientific research after a short break. So we'll take a short break for 10 minutes and then continue after 10 minutes. So yeah, the question on that 85, I'll just, since you have, this on illustration 5 is basically, illustration 4 is basically, the total cost of the plant and machinery is 120. In that, scientific research is not an eligible asset on which you can calculate depreciation. So you reduce 15 and 20 is in second-hand machinery. This 20 crore belongs to a second-hand machinery. Additional depreciation is only allowed for new machineries, not second-hand machineries. So this 20 is also not allowed. So 35 minus 120. So 100 minus 50. So this is what I informed as 85. So additional depreciation is calculated on this 85. The 17 year is calculated on additional depreciation. That is 20% is calculated on 85. So 85 into 20% is 17. So that's how we calculated this. And Yashoda, when can I get uploaded PPT? For all those questions on PPT, I will upload it immediately after the session with the markings. Whatever I marked on the slide will also be available for you so that it will help you out. Mansha, how to differentiate block? See, when it comes to block of assets, so you have building. Okay, so building is one block, furniture and fittings is a category, and then you have plant and machinery. And then another thing is ship. Okay, ship is hardly actually tested in your question paper and all. So probably I would not have covered in the yesterday rates. So these are the 4 things: building, furniture and fitting, plant and machinery, and ship. Under these, there are blocks. For building, you have 5% category, 10% category. Furniture and fitting, it is only one category. For plant and machinery, you have so much: computers, vehicles. So in plant and machinery, you have so much: computer, vehicles, then what else? Your books, and then other plant and machinery. So you have so many categories. So how do you actually differentiate? So you need not differentiate. You must know whether it falls under plant and machinery. You must know the rate. So know the category, know the rate. So plant and machinery, 40% is one block. Plant and machinery, 15% is one block. So you can divide it like that. So that's how you can probably do it to understand this. So that's how you probably differentiate it. Okay. So now I'll move on to the next topic, that is scientific research. So for scientific research, we will first understand some key terms. Again, this is also defined in section 43 only. 43 only talks about what scientific research is about. So what is scientific research is discussed in section 43.4, if I'm right. So 43.4. 43.1 was cost. 43.6 was WDV. 43.4 is your scientific research. So now this 43.4 defines your scientific research. So any activities for the extension of knowledge in the field of natural or applied science, including agriculture, animal husbandry, or fisheries. So these activities, all these activities which I have referred here, that is, it is related to science, related to application of science, natural or applied science. So it includes agriculture or animal husbandry and fisheries. So these are the list of items where they say that if you are involved in any activities whereby you are extending the knowledge in the field of natural or applied science, including agriculture, animal husbandry, and fish. So if these fields are called your scientific research. So typically, how do you remember? Anything related to research on scientific related matters is scientific research. In this, you must know the categorization. That is, what are all the assets that are basically eligible, not eligible. So for that, what the provision says is, it says all expenditure, that is all expenditure incurred for the prosecution or provision of facilities for the prosecution of scientific research. So typically expenditure made for setting up the facility, or providing the facility. So for using, for doing, for carrying out the scientific research, If you are spending anything, then it becomes your related to general scientific research. But it does not include acquisition of rights. So, in or arising out of scientific research, what do you mean by acquisition of right? It's something like a patent, a trademark. So, what can you call it as acquisition of right? You can preferably call it as patent, trademark. All of this can be called as acquisition of right. So, there is already an existing research carried out. I'm just buying that research. This acquisition is not scientific research. So, you must carry out the scientific research. You cannot acquire the scientific research. So that's what we are actually referring as acquisition of right. So acquisition of right is not an eligible scientific research expenditure for the section 35. See, the deduction scientific research is discussed in section 35. The 43.4 that we are saying is definition of scientific research. And sometimes you might be involved in scientific research business. Your business activity itself is scientific research. So any scientific research which may lead to facilitate an extension of that business or the case of all business of that class. So because of various scientific research, I am expanding my business. I am making my business what? I am extending the facilities of my business. So if I'm doing anything related to that, then that is also scientific research. Similarly, any scientific research of medical nature which has special relation to the welfare of the workers employed. So now I'm not in the business of scientific research, or I'm not using scientific research to extend my business or something of that kind, but I'm doing something for the welfare of my own employees. So I'm doing some application of scientific research, probably in the medical field, for the welfare of my employees. So that is also scientific research. So scientific research is basically any extension of knowledge in the field of natural or applied science. General scientific research includes any expenditure for facilities, for prosecutions or provision of facilities for doing scientific research. And then in perspective of business, scientific research may lead to extension of business facilities, or it could be for the welfare of the employees, some medical expenditure for the welfare of the employees. So this is scientific research expenditure. When you say scientific research expenditure, it also includes preliminary expenses. So what do you mean by preliminary expenses? Before commencement. So if there is any expenditure, revenue or capital on scientific research related to business, incurred prior to commencement of business on payment of what are all the expenditure, eligible expenditure, salary, purchase of materials. If you have spent these expenditures, the aggregate of such expenditure within 3 years. So 3 years immediately preceding the previous year commencement of business shall be deemed to be the scientific research in the year of commencement. So 3 years. So what are the key things that you need to remember? This preliminary expenses include revenue and capital expenditure. What are the allowed expenditure? Salary and any purchase of materials. So any purchase of material and salary is allowed. What is the time period? 3 years. Correct? So when you say preliminary, one thing that you need to understand is nature. It could be revenue or capital. Correct? And then we step about expenses that we are talking about. What are the expenses we are talking about? Salary, purchase, and then period. What is the period? 3 years. So 3 years before commencement. So whatever has been incurred within 3 years of commencement, it is allowed. It is considered as the expenditure in the year of commencement. So that is what you're calling as preliminary expenses. So your scientific research expenditures in the past 3 years of commencement, such as salary or purchase of material, can be considered as a scientific research expenditure incurred in the current year. So if my commencement is in previous year 21-22, I can go back 3 years. So I can include 2020-21, 2019-20, 2018, 19. So these 3 years is an eligible year. So that's what you're calling it as 3 years preceding the commencement of business. 3 years immediately preceding the commencement of the business. So if my business is commenced in 21, 22, 3 years immediately preceding that. So it's exactly the date. It's not even the year. It is 3 years immediately preceding the commencement of business. So if it is 1st April 21, then this applies. 1st April 21, from 1st April 18 to 31st March 21. So this is the period of preliminary expenses. Clear? So moving on. This scientific research, we are going to categorize into 3 broad categories. One is, I am incurring for my own business. Please understand the deduction is eligible 100%. Whatever you are spending is eligible. So the first category is, I am incurring for my own business. So I have a business. In my business, I am doing some scientific research. So my business itself is into scientific research. So that's the first thing. So my business itself into scientific research. Second is, I am paying to company, institution, or association. We'll talk about what company, what institution, what thing. We'll discuss about that. So I am paying to a third party. That is also eligible as scientific research deduction. The third category. So we said 1, 2, and the third category. Third category is, I am doing an in-house research development. I am doing an in-house research development facility, provided that the expenditure is not related to land and building. So I am doing an in-house research and development, provided that expenditure is not land and building, not land and building. So now these are 3 of the broad categories: incurred for own business, paid to company, institution, association, and finally in-house research. For these three things, we are going to understand what expenses are eligible, how much can be claimed as deduction. So I said 100%. So we are going to understand what is eligible as for deductions, how much is eligible for deduction. So that's what we are going to understand. So we learn one by one. First, we learn 1 and 3. So we learn these two first, 1 and 3. Okay. So as far as this 1 and 3 goes, the 1 is incurred for own business. We said it is incurred for own business. How much is eligible? 100%. How much? 100% is eligible. Now this incurred for own business could be in the nature of revenue expenditure, could be in the nature of capital expenditure. Revenue expenditure is also eligible. Capital expenditure is also eligible. But in capital expenditure, what is not eligible? Land. Land is not eligible. So out of all capital expenditure that you are making for your own business, the incurred for your own business is basically they are into the business of scientific research. So this incurred for own business is eligible. If my business is in scientific research, I may make revenue expenditure, I may make capital expenditure. I can claim this as 100% of expenditure as deduction. But the deduction is not applicable for land. So that's the only condition here. And the third category we said about is in-house research. So in-house research development facility not being land and building. So I'm doing an in-house research facility. Here, the business itself, business objective is scientific research. So when I'm saying own business, my business is in the field of scientific research. In that case, the revenue expenditure and capital expenditure is considered as a deduction. But if my business is not scientific research, but I have an in-house research and development facility, provided that investment is not in land and building. So I have an in-house research and development. What are not eligible expenditure? Land and building is not expenditure. So here also, capital expenditure is allowed. 100% of capital expenditure can be claimed. So, but the expenditure should not be related to land and building alone. Now, this is bifurcated into 2 categories. One is the in-house research and development. the company is actually into the business of biotechnology. So the company of business of biotechnology has in-house research and development. For that, they are spending anything that is eligible as deduction. Or they must be in the field of manufacturing or production of any article other than 11th schedule. Other than 11th schedule. What is typically 11th schedule? 11th schedule, you can actually call it as hazardous. What is not good for your health. So when you say hazardous, let's say tobacco, something which is not good for your health is what we are actually calling it as hazardous or something. So 11th schedule articles are typically the ones which are not good, which are not properly, which are not actually a good kind of business. That which is not encouraged, which is not encouraged. So if there is anything that is part of 11th schedule, then it is not allowed. So that's what it is about, the relating to manufacturing or production field. So that's what we are actually discussing there, correct? So and then the next category, what did we say? The next category we said was in the field of, that is paying to a third party company. So now I'm paying to a third party company. So the third party company I'm paying, here also I'm eligible for 100%. If the first condition, first category in that is, I'm paying to a company, I'm paying to an Indian company who's into scientific research development. So SRD is nothing but scientific research and development. So scientific R&D. So their primary objective is itself is into scientific R&D. If I am paying to such company, I am not a company into scientific research. I am not a company into biotechnology. I am paying to another Indian company. I am paying to an Indian company. What is Indian company? Indian company is a registered company under the Indian Companies Act 1956 or 2013. So this company, if it's the main object itself is scientific research development, then for that company, this scientific research development, whatever is being contributed, is actually eligible as deduction. And then next thing is, I'm paying to a university, college, or other institution or research association. I'm paying to an university, I'm paying to a college or other institution which are into, or other research association. They are into either directly into scientific research or social science or statistical research. So scientific research, social science research, statistical research. If they are into one of these three, then that is also eligible. So I'm paying to a university, college, or other institution or research association. They are into what? For what am I contributing? I'm contributing for scientific research, social science research, statistical research. So this thing is actually eligible for 100% deduction. The next category is national laboratory or university or an Indian Institute of Technology. So IIT or national laboratory for scientific research. So I'm contributing to national laboratory or Indian Institute of Technology for scientific research material. So for here also it is eligible for 100% deduction. One thing that we must note in both these things is no other deduction. Please understand this. No other deduction under any other provision. Once I've claimed deduction under Section 35, I'm not eligible for any other deduction under any other provisions of this Act. So I'm not eligible for depreciation because depreciation is also deduction under Section 32. I'm not eligible. Similarly, I'm not eligible for any other deduction across the Act. Once I've claimed this 35, I'm not eligible for anything else. So that's what we are calling it as. So clear? So we have discussed the three categories. Incurred for own business, paid to a third party, in-house research, or in-house research and development facility. So that's what we are calling as three category. In incurred for own business, whose main object is scientific research. It could be a revenue expenditure or a capital expenditure, provided that it is not a land. In that case, 100% is eligible. In case of in-house research and development facility, if I'm in the business of biotechnology or I'm in the business of manufacturing or production, any article or thing other than the article specified in 11th schedule, other than those specified in 11th schedule. And then the next category we have said is paying to a third party. In that first we said Indian company involved in scientific research development. and then university, college, or any other research association for scientific research, social science research, statistical research. And then you have national laboratory or university or an Indian institution of technology for scientific research. So these are broadly areas about scientific research. Other points that we must understand in scientific research is the concept of carrying forward the unabsorbed scientific research is similar to unabsorbed depreciation. So if I don't have sufficient profits to set off this expenditure, I can carry forward for n number of years to set it off with any number of years in the future years. So no depreciation shall be admissible. So I cannot claim depreciation because I've already claimed here no other further deduction is allowed. So no depreciation is allowed. One other thing that we must remember is, what if I'm actually transferring this asset? What if I'm actually selling this asset, scrapping this asset, or I'm using it for any other purpose? Now, it will be treated as deemed income. A portion of thing will be treated as deemed income if I'm using it only for scientific research and I'm subsequently scrapping it or selling it. What will be the quantum of deemed income? It is lower of the following. First is sale proceeds plus 35 plus capital expenditure. Second is amount of deduction. I'll take an example. Let's say my sale proceeds of the assets, sale proceeds. Let's say I am into a business of scientific research. Okay. Now, I claimed deduction under section 35 in 2019. Now I am selling in 2022. Okay, 22. Now what happens is, in 22, let's say my deduction in 35 cost is 100. Deduction is also 100. Of course, 100% of the cost is eligible as deduction. So I've claimed 100. Now I'm selling in 2022 for 80. So section 35 says, section 41, deemed income is under section 41. So section 41 clause 3 says, when you're selling or scrapping or whatever you're doing with the scientific research and such, you must take lower of the following will be the deemed income. So first is sale proceeds. Sale proceeds plus 35 deduction minus capital expenditure. If you actually see, this both will be same. This will also be 100, this will also be 100. So technically, you only consider sale proceeds. So how much is sale proceeds? 80. Second is deduction under section 35. How much was the deduction? 100. So whichever is lower, which is lower? 80. So 80 will be treated as deemed income under section 41 clause 3. Sorry. And such income shall be taxed even if business is no longer in existence. So if you are having a scientific research asset which is subsequently being sold off or transferred or whatever happens to that asset, the sale proceeds plus amount of deduction minus capital expenditure or amount of deduction under section 35, whichever is lower will be treated. So in case if it is scrapped, instead of selling, if it is scrapped for, let's say, 5 only will be taxable. So that's what the provision is. It says sale proceeds or deduction under section 35, whichever is lower. Clear? So these are the additional things that we need to understand. Okay. So now we'll see a problem for this scientific research. Amount paid to approved Indian Institute of Science. So it is for scientific research only. So it is eligible. Under what category? Indian Institute of Science. So it is for scientific research. So we said any university, institution or something. So it falls under that category. Amount paid to IIT Delhi, Indian Institute of Technology. There is a separate category for Indian Institute of Technology. National Laboratory. national laboratory or Indian Institute of Technology. So this is also allowed. 3.5 lakh is allowed. And then amount paid to X Limited. So it's a company in India which has its main object of scientific research. So it is eligible. So this is also categorized under paid to. So these are all paid to third party, paid to a company, paid to an institution, paid to a approved a laboratory, that is Indian Institute of Technology. So that is there. And fourth thing is expenditure incurred in in-house research and development as prescribed authority. Revenue on scientific research is 3 lakh. Capital expenditure is 7.5 lakhs, including cost of land of 5 lakhs. So in this, how much only is eligible? Only 2,50,000 is eligible. So 2.5 plus 3, 5.5, 9.5, 10, 12, 13. So totally 13 lakhs can be claimed as deduction. If profits are not sufficient, you can carry forward for n number of years and set it off in the future years. So that is what your scientific research is about. So I'll answer some of the questions for scientific research. Harshita, for inadmissible deductions, we covered 30. 30 is about building, that is repair, maintenance, rates and taxes, insurance for building. Section 31 is for repair insurance for machineries and plant. And then section 32 is depreciation. Now we are covering 35. So these are the sections we have covered. Shivam Singh, paid to ISRO. Yeah, see, ISRO, the main objective of ISRO is obviously space, right? So the main objective being scientific research, we need to see whether it will come under the category of paying to an Indian company under scientific research. So this is if it is a company. Now this Indian Space Research Organization is not a company. It is basically, let's say, it's an association who is involved in scientific research. So it is eligible. So you are paying to any university, any institution. This ISRO is typically not an university or institution. Whatever we are covering here, we are talking about university, college, institution. So now whether Indian Space Research Organization is institution, yes, it's still an institution. So we'll keep it in this manner. It is eligible if it is either an university, college. Apart from university, college, the only thing that falls under this is research association, institution. So I am not sure whether Indian Space Research Organization will fall under this, but their objective might be space research. But if they are falling under the research association or institution, it is eligible. So if they fall under that category, they are eligible for deduction. So that's what it is. So the basically, how did I come at 13 lakhs? It is 1 lakh plus 2,50,000 plus 4 lakhs plus 3 lakhs plus 5 lakhs. So all this put together is what? 13 lakhs. So that's what is allowed. Scientific research in the field of medical science, research on vaccination is allowed. So we actually said that if a particular company, we were talking about a scenario where the company is in the field of medical things. So when we are talking about scientific research definition, we said for special relation welfare of workers employed in a medical nature. So that is allowed. And we also spoke about in the business of biotechnology, right? The business of biotechnology. So this also we discussed. So typically in the field of medical science, you are still under scientific research, you are eligible. So you might be your own company under medical research, it is eligible. Okay, clear? 5 lakh wrong, 2.5 lakhs. Oh, I'm sorry. Yeah. Thanks, Madhuri. So this is 2,50,000. I guess 13 lakh was right because I totaled it with 2.5 only. So 3.5, 7.5, 10.5, 13. So the answer 13 is correct. Just that I should not have written 5 lakhs. It should have been 2.5 lakhs. Why 2.5 and not 5? Because land is not allowed. Only the difference, that is 7.5 minus 5 of 2.5 is allowed. So thanks, Madhuri, for that correction. Okay, so we'll move on to the next section, 35AD. 35AD is also on admissible deductions. It is specifically called as specified business. Specified business. It is actually called as investment-linked tax incentive. Investment-linked tax incentive. So these are the list of businesses for which it is eligible. If you ask me, this section is more important for final. Intermediate, I don't think to what extent you will be tested on this particular section. But however, it is an important section. But at an intermediate level, I'm not sure how far you will be tested. So I'll just give a brief idea of what this section is about. These are the businesses. That is, there are around 11 businesses listed here. So cold chain facility. Cold chain facility means storage. Cold storage. So there is cold storage facility. So that is called as cold chain for storage of meat, various fruits or other things. So cold chain facility. And then business of warehouse. So you are providing a business of warehouse. This is also in the field of storage. So warehouse for what? Agriculture produce or sugar. Or you are in the business of laying and operating gas pipeline, crude pipeline, or any other oil pipeline. So if you are in the business of laying and operating this business, you are eligible for deduction under 35AD. You are running a hotel which is 2-star or above, you are eligible. You are running an hospital at least with the 100 beds for patients, you are eligible. You are in the business of building housing projects, which is categorized as some slum redevelopment by the government or affordable housing projects by the government. It is an eligible business. You are in production of fertilizer, it is eligible. You are building a transport hub. You are in the business of transport hub where you are running actually a freight station or a depot, a customs depot, an international customs depot. So that is also a transport hub. So depot for customs, that is also allowed. Then you are in the business of bee, the honey bee, right? Keeping or beekeeping or production of honey. So that is also eligible. Fabrication of semiconductor water, that is also eligible. Infrastructure facility, that is building roads, bridges, all these infrastructure facilities is also eligible. If you are running any of these business, then you are eligible for 100% of capital expenditure can be claimed as deduction. And it is here in scientific research, we said land is not allowed. But here, land, goodwill, financial instrument, these three are not eligible. So land, goodwill, or any financial instrument. When you say financial instrument, any securities or something which has financial value, the financial instrument is also not allowed. So land, goodwill, financial instrument are not an allowed expenditure in this case of 35AD. And when you say preliminary expenditure, that is prior period, before commencement, if you have incurred something, it can still be claimed as the deduction in the year of commencement if it is capitalized on that particular date. If your business is commencing on 1st April 2021, you have invested in an asset in 2018, but the capitalization date of that asset is 1st April 2021, same as your commencement date, then it is eligible. So deduction in the year of commencement. So you can claim deduction in the year of commencement for prior period investment, for investments made in the prior period, if it is capitalized on the start date, that is commencement date. So if it is happening there, that is eligible. One thing that we need to understand is section 40A3 applies for this section 35AD also. So what is 40A clause 3? 40A clause 3 is if an expenditure is made in other than the prescribed modes, that is banking mode, electronic prescribed modes, account pay check, account pay draft. If it is paid through any other mode other than this, with a value of more than 10,000, then it is not an eligible expenditure. So that is where section 40A3 comes into the picture. Clear? So 35AD is eligible for these businesses from cold chain to infrastructure facility. and 100% of capital expenditure can be claimed as a deduction, but it is not eligible for land, goodwill, financial instrument. And if you have made the investment prior to commencement, you can claim it in the year of commencement, provided it is capitalized in the year of commencement. It can be claimed in the year of commencement if it is capitalized in the first date of commencement. So that's what the provision is about. Some of the other things that you need to consider for this particular category is okay. I'll go through some of the. There are two illustrations, and then I'll go through this. So illustration 6 is basically Mr. A commenced operations for setting of warehousing facility. Food grain. Food grain is what? Agriculture produce. Sugar is ineligible. Edible oil warehouse is not eligible. Laying and operating pipeline for oil, crude only was allowed. Not edible oil warehouse is not allowed. So edible oil is not an eligible expenditure, eligible business on 1st April 2021. So he's incurred expenditure of 80, 60, 50 for 3 businesses. What has he purchased? He has purchased land and building. For the above business, capital is the same in its books of account as on 1st April 2021. He has actually incurred in January to March. That is prior commencement, but capitalization date is when? 1st April 2021. So the cost of land included in the above figure is 50. So the cost of land is 50, 40, 30. During the previous year 21-22, he incurred capital expenditure of 2015-10. That is current year expenditure. 2015-10 for extension or reconstruction of building purchased and used exclusively for the above business. So there is further expansion. So 20 lakh, 15 lakhs and 10 lakhs for 3 businesses used. Compute the income for these 3 businesses. So we need to understand which is eligible and which is not eligible. Correct? Out of these 3 businesses, what is eligible and what is not eligible? What is eligible is basically your food grains and sugar is eligible, whereas your edible oil is an eligible expenditure. That's what we are talking about, correct? Now we need to compute this. So we'll have to compute these 3 businesses. So we'll start with first computation of profit and gain. So illustration, what number? 6 is it? 6. So illustration 6. Computation of PGBP, okay, for assessment year 2022-23. Let's take particulars amount. So they have given you we'll have to see whether they have given the profit of the business. So it says compute the income under PGBP for to be lost to be carried forward, assume that Mr. A has fulfilled all the conditions. He has not claimed any other deductions in the chapter 6A. The profits from the business of setting up a warehouse facility for the storage of food grain and sugar. So they have given the profit 16, 14, 31. So the profit of edible oil, profit is 31 lakhs, correct? Profit is 31 lakhs. In this, if you actually see, now it says before providing deduction under section 35AD and 32. So 35AD is also not provided. 32 depreciation is also not provided. So now for edible oil, depreciation must be provided. Profit oil. So depreciation under section 32. Depreciation, it is eligible only on building. Okay, it is eligible only on building. There is no depreciation on land. So if you go to this thing, total investment is 50 lakhs for your edible oil. Out of that, 30 lakh is land. So that is not considered. So 50 minus 30. Then incurred capital expenditure for reconstruction of building. So this 10 is also included. So 50 minus 30 plus 10 into what percentage? It is commercial building. So it is 10%. Correct? So 20 plus 10, 30. So you get 3. So it is 28. So that is your PGBP. Now we need to calculate the exempt related. How much of 35 AD is exempt, correct? So for this, we'll have to do it for two business. Particulars, food grain, sugar, and then let's keep it as total. Okay. So for this, what I will saying, we are saying the total profit from the business. So we'll have to start from the profit. So profit for food grain is 16. This is 14. So 16, 14, 30, correct? Here, less 35 AD deductions. So the first thing is prior period capex. So it has been capitalized on 1st April 2021 only. So whatever was actually commenced earlier, prior period is what? Out of 80, 50 is land, so 30. Out of 60, 40 is land. So 30 and 20. Correct? 30 and 20. So 50 is prior period. And current year. Current year is only building. So current year building is 20 and 15. So current year building is 20 lakhs and 15 lakhs. So you have 35 lakhs. So this is what is there. So what is the total expenditure? $50, 35, $50, 35, and 85. So this is the total expenditure. Now we are eligible for less 100%. Correct? 100%, 50 is eligible, 35 is eligible. So total is 85. Correct? So 50, 35, and 85. So now 16 minus 50, that is your what you call profit / loss. 16 minus 50 is 34. 14 minus 35. 14 minus 35 is 21. 34 plus 21 is 55. This is all loss. Correct? So this is loss. Loss that will be carried forward. So this loss will be carried forward and set off with other specified business. So that's what the provision is all about. Okay, and then the next problem, illustration 7. So illustration commenced operation of business of a new three-star hotel, incurred capital expenditure of 50 lakh during period. Again, during prior period, he has incurred 50. On 1st April, he has incurred another 2 crore. Out of that, only 0.5 is not for land, other than that, it's land. So 50 plus 0.5. 50 lakhs plus, 50 lakhs, this is 0.5 crores. So this is also 50 lakhs, correct? So 50 lakhs plus 50 lakhs is totally 1 crore. So 1 crore is an eligible expenditure for claiming your expenditure. Now in this, next is compute the total. So my total, the business of hotel, business of running this hotel before claiming deduction is 25 lakhs. So my 25 lakh is the thing. So 25 minus 100. So there is a loss of 75. Assume that you also another existing business of 4-star hotel in Coimbatore. 15 years back, it is 120 lakhs. Since that is also hotel business, I can adjust this loss of 75 lakhs with that business. So 120 minus 75 is what? 45. So 45 will be my taxable profit from this business. So 45. So this 45 lakhs will actually be my taxable business profits. So other points relating to the specified business, if the asset once used for this claimed as deduction under 35 AD, it must be used for the period of 8 years beginning with the previous year in which asset is acquired. So from the year of acquisition, it should be used for 8 years. But if it is not used, if it is used for some other purposes within 8 years, then the deemed income under section 14 will be total amount of deduction so claimed minus deduction depreciation under section 32 as if the deduction was not provided. So that's what it is about. And then the same shall not apply if the business has become a sick industrial. So this is not applicable. This provision is not applicable if your business is sick industry. If it is actually the entire sale proceeds plus insurance shall be claimed if the asset is actually demolished, destroyed, discarded, or transferred. So whatever is the sale proceeds, that is your whatever is your sale proceeds or the scrap value, whatever it is, plus the insurance compensation shall be your income. In case if it is demolished, destroyed. In case if it is used within 8 years for other business purposes, then this will be. So this is how you compute for this. So that is how you actually calculate your income if you are misusing this asset. And of course, this deduction is eligible only when you file Form 10CCB with the return of income, before your return of income. So only then you are eligible to claim deduction under section 35AD. So that's all about section 35AD. So to understand this transfer example, Unit A carries on a specified business for storage of sugar. Unit B non-specified business, warehousing facility for edible oil. Unit A is commencing 1st April 2020, claim deduction of 100 lakhs. Incurred on 2 buildings for 50 lakh each for operating a warehouse facility under section 35. However, in February 2022, Unit A transferred one of its building to Thing. So what happens here? So what is happening here is transferring within 8 years to another business. So what is happening is transferring this business. So typically, what should you do is deduction allowed earlier. Deduction allowed earlier will be 50 lakhs. Correct? So 50 lakh is the one which is already allowed as deduction. We should provide depreciation as if deduction was not allowed. So less depreciation. Depreciation is only for 1 year because it has only occurred on 1st April 2020. So for 1 year depreciation, it is 10%, that is 5 lakhs. So 45 lakhs will be treated as deemed income. So this 45 will be treated as deemed income and taxed in that year. So that's what it is about. Clear? So any queries or doubts related to this? So I'll just answer some of your questions. Why didn't we calculate additional depreciation for edible oil in illustration 6? So in illustration 6, typically what we are saying is land and building. Additional depreciation is allowed only for plant and machinery. It is not eligible for building. So that's why we have not calculated additional depreciation for edible oil acquired during this previous year in illustration 6. Why 100% capital expenditure is allowed under section 35AD? So 35AD is a deduction on its own. So whereby we say these facilities, that is cold chain, warehouse, and all these business that has been listed here, similar to your scientific research, here also we are saying if you are making capital expenditure, you can claim 100%. Why do we do that? If you see all these industries that are listed here are capital intensive industry, which means you need to put lot of money to start this. And government feels that this business must be promoted. So when can you promote a business? When you say that you are eligible for various tax benefits. Only then you can say that it is eligible. Now, when you say this businesses are eligible, so typically government now says, if you open up a 2-star hotel or above, I'll give you benefit. If you open up an hospital, I'll give you a benefit. So they are promoting infrastructure facility. They are letting the country grow by building more hotels, by building more hospitals, building more roads and other things, bridges and other things, right? So the government wants to promote. How do they promote? They say, I'll give you complete benefit of, you did not do depreciation year on year. Instead of depreciation, I'll give you 100%. I'll give you 100% as deduction that can be actually applied. So that's what being called as 3580. So it is just to promote. I say 100% of capital expenditure is allowed as deduction under section 3580. So Arshita, the entire capital expenditure incurring other than land, goodwill and financial instrument is eligible for 100% deduction. Just that you are not eligible for any other deductions, depreciation or any other deductions under any other provisions of that, you are not allowed. So that's what it is about. So the question on whether scientific research, ISRO categories as scientific research, yes, they are in space research. We said natural or applied science. So ISRO might be in some scientific research. I only said I do not know whether ISRO is actually involved in such activity. If they are involved in such activity, and then if they are categorized as a research association, they are eligible. So that is purely depends on what is the nature of ISRO is about. But as far as your question is concerned, the question will specify to whom scientific research donation is made, whether what is the objective, whether they are into scientific research or social science. The question will specifically state that they will not give you an organization for which we do not know whether they are in scientific research or not. So with respect to whether it is eligible for ISRO or not, ISRO, in case they also have a category of scientific research association category, then deposits could be eligible for donation. Otherwise, I do not know whether it is actually part of it or not. Siddhappa, what exactly does sick industry mean? Sick industry is basically where, let's say, I'm continuously making losses for 3-4 years. My net worth is eroded. I'm not able to recover from here on. So there is an organization, there is an institution to categorize yourself as sick industry. So you go and register yourself as a sick industry, which means you are an industry which could not recover and come back. So for that kind of entities, this 8-year rule of utilizing the 3580 asset is not applicable for this sick industry units. So that's why we said it is not applicable for sick industry units. Okay, and then please explain illustration 8 again. Before that, there's one more question. Madhuri wants to know, how can we set off loss of hotel? Which illustration was that hotel? This 3580 says specified business is one category of business. So with one business loss can be adjusted with another business. So if you have one business as loss, another business as profit, both categorized under specified business, then it is eligible. So now the hotel in Coimbatore, it's an eligible business under 3580, just that it is currently not claiming any deductions or something. So moment it is a hotel, which is actually an eligible business, it can be adjusted. So that's why we are adjusting the Coimbatore business. The 120 profits are used to adjust 75 lakhs crores, right? 75 crores of 75 lakhs. Yeah, 75 lakhs of loss adjust. So you can adjust with another eligible industry under 3580, whether they are claiming or not claiming. Please explain illustration 8 again. See, illustration 8, what we are saying is, we are saying an asset was claimed as 3580 under Unit A. So in this period, that is in 1st April 2021, that is in previous year, 2020-21, they have claimed 100 lakhs of deduction. But immediately the next year, they are transferring 50 lakhs of building to another non-eligible entity, which is not covered under 3580. Okay, now we need to compute since they have transferred the asset within 8 years, we need to compute income. So the procedure for computing income is calculating depreciation till date, taking the total cost minus depreciation till date. So the cost of the building which was claimed as deduction, cost of the building which was claimed as deduction is 50 lakhs. Only one building was transferred. So now this 50 lakh is taken. Depreciation is provided for 1 year. This is depreciation provided for previous year 2020-21 at 10%. So 50 lakh into 10% is 5 lakhs. So 50 lakh minus 5 lakh is 45 lakhs. So that's the depreciation that you are claiming it. So that is why we are saying this 45 lakhs will be the deemed income for it. So hope now we have understood illustration 8, Kaveri. Next, Arshita, I am unable to understand second condition to be filed under 35AD. What exactly is that? Is it related to audit of account is your question? Audit of deduction shall not be admissible unless the account. So to claim this deduction, you must file a form certified by a chartered accountant with the income tax department. Like filing a return of income, you should file a separate form with the income tax department to say that you are claiming deduction under section 35AD. So you'll have to file this in a form. Only then you can claim it as a deduction. Siddhappa, how to approach for exam this chapter? See, I'll just tell you one thing. So typically, this business PGBP, if you ask me, relating to your intermediate, inter is only relating to individual and HUF related provisions. So probably like section 30 is important, 31 is important, 32 is important. These are important, okay? Important. Apart from this, I'll just tell you till whatever we have covered. 35 and 35AD, probably it is a level in final. Probably it is a level in final only, 35 and 35AD. But 35AD, it's 100% final. 100% final. 35 maybe in your intro also could be questioned, because you can always say an individual paid money for scientific research. But if you talk about 35AD, we are talking about businesses such as huge investment business. Individual cannot be running an oil and gas industry or a pipeline industry or something of the kind. So it is very difficult that an individual or HF question will be tested with 35AD. It is very rare. So that's why I'm saying it is 100% final. Madhuri, deduction of 35AD is for every year. Every year for the year in which you are actually investing capital expenditure. So this is eligible for every year. It is eligible for every year, just that in the year in which there is a capital expenditure. If I'm buying a building this year, I'm eligible. Next year, I'm buying a plant and machinery, I'm eligible. So only if I'm actually investing in some capital expenditure, I'm eligible for depreciation. So for every year, I'm eligible, provided I've invested something in capital expenditure. Only if I've invested, I'm eligible for deduction. Otherwise, there is nothing that is eligible. So that's it. I will just stop it with this today, because I guess it is too heavy, whatever I've discussed about chapters today. So I'll stop it here if there are no more questions hereafter. So in next class, we'll cover the other important sections. So probably we'll be covering about areas like preliminary expenses, and then other admissible deductions under section 36 and 37. So with that, we'll have complete understanding of this 30 to 37. We'll also cover section 40 and section 40A in tomorrow's class. So with that, we'll be covering all the deductions that are applicable, eligible admissible deductions and inadmissible deductions. So I'll wind up for the day if there are no more questions. So I will see you next class on 15th. So we'll see you on 15th. So with that, I'll wind up the class today. Thank you for the wonderful session. We'll meet on 15th. Thank you. Yeah, concluded.